In this video, we will explore about various market participants and their activities. When we look at the securities market, it is not just a simple interaction between a buyer and a seller. It is a vast ecosystem. We will look at who the intermediaries are, what institutional participants do, and how retail investors and advisory services fit into this complete picture. Let us start with market intermediaries. Think of this as a connected chain. At the very beginning, we have the authorized person. These are agents appointed by a stockbroker to reach out to investors who are scattered across the country. Effective from April 2019, all sub-brokers migrated to become authorized persons. These agents connect you to the trading members, also known as stockbrokers. You cannot trade directly on an exchange. You must go through these registered members. These brokers then connect to the stock exchanges such as the NSE or BSE. These exchanges provide the nationwide electronic platform where anonymous order matching happens between buyers and sellers. Now, once you have bought securities, where do you keep them? This is where depositories come in. They act like a bank for your shares, holding them in electronic or demat form. In India, we have two main entities, CDSL and NSDL. However, you do not interact with the depository directly. You open an account through a depository participant or DP. The DP acts as an agent and is the interface for the investor. While the depository maintains the company level accounts, your individual investor account is maintained by the DP. These can be banks, financial institutions, or brokers. Moving on, let's understand how the actual exchange of money and shares is handled. This is the settlement mechanism. We have the clearing corporation, which acts as a legal counterparty to all trades. They guarantee that the settlement happens smoothly. To manage the money flow, they work with clearing banks. These banks act as an intermediary between the clearing members and the corporation to manage obligations and receivables. On the other side, we have the custodian. These are specialized entities that look after the funds and securities for large clients like banks and insurance companies. They safeguard assets, settle transactions, and track benefits like dividends for these large investors. When companies need to raise funds from the public, they rely on specific intermediaries. First, we have merchant bankers. You can think of them as the managers of the issue. They evaluate capital needs, handle pricing, and manage the entire process until the securities are listed. Working alongside them are underwriters who act as a safety net. If the public does not buy all the shares offered, the underwriters commit to subscribing to the unsold portion. This assures the issuer that they will raise the necessary capital. The market also includes specialized structures like farmer producer organizations or FPOs. This is a collective of farmers who register as a company or society. By coming together, their primary objective is to improve their bargaining power. They aggregate their produce to reduce production costs and eliminate middlemen. This allows them to access technology and credit more easily, ensuring they get better price realization for their goods. Now, let us shift our focus to institutional participants. We often hear about foreign money in our markets. This comes through foreign portfolio investors or FPIs. These are entities incorporated outside India that must register with SEBI to participate directly in the Indian securities market. However, some overseas investors may want to invest in India without registering. They use P notes or participatory notes. These instruments are issued by registered FPIs to overseas investors, giving them indirect access to Indian securities. We also have massive domestic institutions that drive the market. Mutual funds are very common. They pool money from many investors and are professionally managed to invest in diversified portfolios of stocks and bonds. Then we have insurance companies. While their core business is insuring assets, they manage huge corpuses and are major investors in the economy. We also have pension funds. These are pools of retirement assets contributed by employees and employers, aiming for stable long-term growth to provide retirement income. For investments that require a different risk appetite, we have other funds. Venture capital funds target early stage enterprises with high growth potential. They provide capital along with managerial expertise, but they carry a high risk of failure. Private equity firms typically come in during the growth or expansion stage or even for buyouts. Then there are hedge funds. These funds have a wide mandate to invest across different assets and geographies. Their goal is to generate returns wherever possible, and despite the name, they are not always hedged against risk. In India, these private pools of capital are regulated as alternative investment funds or AIFs. SEBI categorizes them into three types. Category 1 includes funds investing in socially or economically desirable sectors like startups and SME funds. Category 2 includes funds that do not leverage or borrow money for trading, such as private equity and real estate funds. Finally, Category 3 includes funds that use complex strategies, including leverage, such as hedge funds. Apart from buyers and sellers, the ecosystem needs advisors and infrastructure. Investment advisors work with investors to assess their needs and riskability. They create financial plans and propose appropriate strategies. On the commodities side, we have warehouse service providers. They provide storage and silos to reduce post-harvest loss. They also issue negotiable warehouse receipts which farmers can use to get credit. Supporting them are quality assayers. These are certified labs or professionals who evaluate the quality standards of commodities to ensure fair pricing and reduce disputes. There are also specific structures for wealth and fund management. The Employee Provident Fund or EPF is a defined benefit scheme where both the employer and employee contribute 12%. The National Pension Scheme or NPS is a government-sponsored contribution-based scheme where subscribers can choose their funds. For managing the wealth of wealthy families, we have family offices which handle investments, tax, and estate planning. Large organizations also have corporate treasuries to manage their surplus funds, investing them temporarily rather than leaving them idle. We must not forget the individual and corporate participants. Retail investors are individuals investing for their personal accounts. If they invest large sums, they are classified as high net worth individuals or HNIs and ultra high net worth individuals. Even non-resident Indians can invest directly via the automatic route. In the commodities market, we have corporates. These are processors, manufacturers, or exporters who depend on raw materials. Their business margins are affected by commodity prices, so they participate in the market to procure materials and convert them into value-added products. Finally, we have proxy advisory services firms. Institutional investors hold shares in many companies and cannot always track every corporate announcement or proposal. Proxy advisors analyze voting proposals and agenda items for them. They assess how a proposal affects investor interest and recommend whether to vote for or against it. This helps investors exercise their rights effectively without having to analyze every single detail themselves.